Okay. Assalamu alaikum, everyone joining us for this Islamic Personal Finance Bootcamp. I've got Ibrahim Khan with me. It's it's very nice that you managed to take the time off to to present this to us. So I'm not going to talk for too much because that's not why you guys are tuning in. But I'll give a short introduction about Ibrahim, just so you're aware of who he is and his background and his qualifications. So Ibrahim holds a BA in PPE, Philosophy, Politics and Economics from the University of Oxford, and Ijaza in Commemoration of the Quran from Egypt, and an MA in Islamic Banking and Finance from Markfield Institute. He also graduated from the Alamiya program under the tutelage of Sheikh Akram Nadwi. He previously worked as a funds lawyer in London and has lectured extensively on Islamic finance and zakat in mosques, universities and schools around the UK. Relevant to us today, he's a co-founder of Islamic Finance Guru. Anyone who hasn't been on our website, so check it out. It's a website that helps Muslims with their investments, personal finance, and entrepreneurial journey. Me and many of my friends have used it and found it very useful, and something you guys should check out after when you've got the time. But otherwise, I will, welcome Ibrahim to this webinar. And I'll hand it over for you.
Jazakallah khair, Talha. I don't know about everyone else, but I tuned in to listen to you.
Maybe I'll do it a bit at the end, at 10 minutes, just so people can get to see me as well.
Yeah, exactly. Great. Well, Jazakallah khair, everyone, for tuning in. The idea behind today's webinar is that, inshallah, we're going to do a real whistle-stop tour around Islamic finance, personal finance in particular, talking about Islamic investments, Islamic wills, and just general money management stuff as well. And I suppose the key thing that I want you guys to take away is that this is very much a kickoff, right? It's very much an overview. It will, to look into this whole area properly will require probably ongoing work, and it'll require a little bit more research afterwards as well. But what I want to leave you with is a bit of a lie of the land, so to speak. So, you actually know where to look and what you're kind of roughly, getting at. Cool. So let's dive in.
So sorry, Ibrahim, just sorry to interrupt you. What I forgot to say this, probably a bad host, but so the presentation will last approximately an hour, and then at the end there will be like a 15 minutes, approximately 15 minutes for people to ask questions. So those guys, if you've got questions, just save them up and put them in the chat box and comment, and afterwards I'll have a look, and then we know if there's any common themes or popular questions, I'll be putting them to Ibrahim at the end. So engage with the presentation, have a think about any questions that you have. Okay, sorry, Ibrahim, go on.
Brilliant. Jazakallah khair. So objectives are, we're going to go through 4 tiers of personal finance, 3 essentials of investing, and then go through 5 investment categories. Talha, if I start going off on one, then feel free to rope me in, because I can't see the I don't know. I'm literally just punting in the dark. All right, cool. So before we start off, I thought I'd just give you, Talha has already given me a kind of introduction that you would give to Tyson Fury as he walks into the ring. But I wanted to give you a bit of background as to why we've ended up in this place. And I think that's actually really important, because for me, Islamic finance and halal investing and personal finance and money stuff, it's not just about because you need to sort your finances out, or you need to try and make your money work for you and make a bit of a profit if you can. That, for me, it's not about that. For me as a Muslim, it always comes back to what's the purpose of our life? Why are we here? Everything must come back to that. And I'll I suppose talk a little bit about that in just a second. But where Islamic Finance Guru started was just as a community blog about 5 years ago. We were working as corporate lawyers at the time, and we started writing on Islamic finance on the internet, and people found it quite useful. The idea was we pitch it not too basic, so you don't just go online and find this is halal, this is haram, off you go. And it's not so academic like it's written in Arabic Arabic or Malaysian, and it's just far too dense for it to be useful. It was kind of me writing for myself as a, for an educated but also lay audience. And alhamdulillah, people found it quite useful, and we grew our audience. Alhamdulillah, it's continued growing, and now we're full-time an Islamic finance guru. And the thing that kind of drives why we do what we do is that Muslims are, I mean, Talha, any ideas out of the top 200 public companies? Bear in mind, Muslims are 25% of the world's population. Out of the top 200 public companies in the world, how many of them are Muslim origin?
I would maybe like one push.
Well, actually, it's two.
Okay, not far off.
But it's still 1%, right? That's
Yeah.
1% of the public companies, the largest public companies in the world are Muslim, compared to 25% of the world's population that is Muslim. And so Muslims are incredibly underrepresented when it comes to business and entrepreneurship, but also just wealth generally. Muslims are about 20% poorer than the rest of the world. And our mission, given our backgrounds and our interests and our experiences, is that if we can just raise that Muslim GDP, if we can just raise that Muslim wealth globally, then it can address a whole host of issues like underrepresentation in media and politics, overrepresentation in prisons, health outcomes, education outcomes, a whole host of things. And for us, there are two key ways where we do that, right? And this is really the reason why we do IFG, the reason why we packed in on our corporate jobs. There are two ways that we can help Muslims get richer, get wealthier, get more influential. The first is by helping every single Muslim sort out their personal finances, because if you can sort out your personal finances, which is good for you, by the way, then that really can move the needle. Because if you can imagine 25% of the world's population, if they're not currently managing their money properly and they start managing it properly, that really helps. And then the second thing is to make sure the next big entrepreneurs are from the Muslim community, or the Muslims that are entrepreneurial. We really support them and we give them the funding that they need. And we're not really going to talk too much about that second bit, but that's a big part of what IFG does. We have an angel syndicate. We invest in startups. We help Muslim founders. We co-invest alongside lots of interesting, quite prominent investors. But that's the two kind of things. What we're going to focus on today is the first bit: sort out your personal finances. And in light of everything I've said, I think of this as a religious duty for each of us to manage our money properly, because this is an amana. Because ultimately, you are just a steward of the wealth that has been given to you, right? You are just a steward of the body that has been just given to you and the chances that have been given to you. And Allah subhanahu wa ta'ala, He wants us to marshal them in a way that is going to maximize the purpose of our life, which is to worship Him and Allah subhanahu wa ta'ala, and to put what He wants before what we want. And so that's why we're doing this. Okay, cool. So what is personal finance? Any ideas? Any ideas?
Sorry, say that again. My sound cut. I didn't catch that. Say that again.
I said, what do you think personal finance is?
So I guess broadly managing your money, but I guess techniques on how to save money and grow it.
Yeah, definitely. I mean, I think that's pretty much it. If you do personal finance well, then I think it can really set you free. It can make you lots of money. And it's basically, in a nutshell, the idea is that personal finance is how you approach your money, the philosophy of how you approach your money, and what you do with it. So there's 4 tiers of personal finance that you should focus on. The first thing is, if you've got debts, and by the way, what I mean by debts is not your mortgage, for example, or your long-term credit cards that you're quite easily paying off. Like, let's say you've taken out a 3-year zero interest credit card and you're paying that off perfectly fine. I don't necessarily mean that. I mean debts that are mounting up, that are interest, accruing there, and they are really, really problematic. Those are the kind of debts I'm talking about. We should try and definitely clear them, and that includes, by the way, student loans. I don't think you should go crazy and go without food and that sort of thing, or even put your marriage on hold, or not buy a house to clear your student loans. But you should try and accelerate that as much as you can. I think it's financially sensible as well. So once you've cleared your debts, the second thing is build up a 3 to 6 month buffer in liquid savings. What do I mean by liquid? So something liquid is cash, or it could be something that is really easily accessible. That's basically what liquid means. So stocks and shares in an ISA is liquid because you can easily withdraw it, whereas your pension is not liquid because you can't get hold of it until you're 65 or 55 or whatever it is. So that's the second thing, 3 to 6 month buffer. And that is worked out by, you working out and saying, okay, look, it costs me about £1,500 or £2,000 these days to run my household. And let me just times that by 6. And there you have what you should be aiming for as your kind of, rainy day pot. And you should be putting that into something that you can easily access, as I said, like in a savings account or in stocks and shares or something like that. And the third thing that you should do is thinking about, and this is actually roughly following, in a way, people's, life plans. Because once you've got that initial pot of money, people then start thinking about buying a house. And when it comes to buying a house, it's not always the case that buying a house is better than renting, but it nearly always is the case that buying a house is better than renting. And we have a should I buy or should I rent calculator, which our tech wizard that works with us at IFG came up with, and it pulls together in the background all sorts of different interesting algorithms and little calculations, and it spits out basically, if you put in what you're currently paying in rent, or what kind of house price you're looking to buy, etc., etc. You can fiddle around with a few things. It will tell you, should you buy or should you rent? And I think that's really compelling. And for most people, they will end up saving literally hundreds of thousands by getting a house. And I'm not going to talk too much about Islamic mortgages, because I understand that you guys have been talked to about that quite relatively recently. But we have the I believe only Islamic mortgage comparison website on our website, and you can check that and compare between Gatehouse, Al Rayyan, Al Ahli, and all the different permutations of their products that they have. Inshallah, that will help you get onto the property ladder in an Islamic way. And then finally, once you've got through all of that, then you can do the really exciting stuff, which is building a diversified portfolio into all sorts of weird and wonderful asset classes. I want Muslims to be eventually, inshallah, rich enough to start thinking about, investing in art and all sorts of things. And maybe in 40 years' time, when we've achieved our objectives, I'll have a presentation just purely on art investing, which I don't know anything about, by the way, but inshallah I'll learn. Cool. So we have one life that we live, and all of it is studded with financial checkpoints wherever we go. So I'm going to keep this really, really quick, and I appreciate that there's probably presentations to be made on each of these points, but please do bear with me. So the first is a junior ISA. This is a sort of thing that you can set up at birth for your children. It's a tax-free wrapper that you can put £10,000 into. Technically, this is your children's savings, but that is, that's guidance that's addressed at a non-Desi audience. I think my dad, I'm not sure he used it necessarily in that way. So you've got junior ISAs, and they are a great way for saving for your children's in universities, for university fees, for example. You can also set up a child's SIP, which is a self-invested pension plan. So if you set up a SIP for your children, and you start putting in just a little bit of money every year, by the time, and I think I did the numbers, if you just put in about 3K a year for their entire 18 years, then by the time they're 65, they will have £1 million. and potentially more than that, actually. It depends on the returns. And even £50 a month into anything like this will add up to £350,000. And there's a video we did on our YouTube channel very recently on how to avoid student loans. And one of the key things that we said on there was that if you are literally, saving 50, 60 quid a month, then that can really, really significantly move the needle when it comes to avoiding student loans. And I think that's something that we should all, as a priority, especially those who have younger kids, we should look at doing. And this is something I'm going to be sorting out for my own son, because it's, as we'll go into, it's about thinking very, very long term. Because once you think long term and you just forget about that good decision you made 20 years ago, you really come to value it many, many years later. Cool. So avoid student loans, try to work, get a student scholarship or bursary. This is for university. I won't talk about that. I'll just point you to the YouTube video where we talk about this in a lot more detail. For your first job, make sure that you get yourself onto the pension scheme, because your employer is legally required to match your contribution up to a certain point. I believe it's 3%. And that is literally free money. So it's worth reiterating that point because it's that important. Your employer, if you are not on the pension scheme, you are literally giving free money away. You're literally, throwing away free money. And that free money, like if I said to you, I will give you £100 and, you go and invest it and find me the best investment that you possibly can, I would be very, very surprised if you found something more than 10, maybe even 15%. But this is literally 100% return on your investment immediately because your employer has to contribute. Now, of course, one of the key caveats is that this needs to be a sharia-compliant pension. And most employers these days, so for example, if you're in the public service, if you have a defined benefit pension, final salary pension, i.e. a pension where you get paid out at the end depending on the numbers of years of your service, etc., and it's not really dependent on what actually happens with the money underlying. So for example, an NHS pension is like this, then you don't need to worry at all. You should just contribute to that pension because it's great and it's sharia compliant for your purposes. But if you have a contribution benefit, direct contribution, defined contribution benefit pension, then you, i.e. a private pension, in other words, and lots of private companies have that, then you need to make sure that your money is being invested into sharia compliant funds. So Aviva have a sharia compliant fund on there, Scottish Widows do, and a few others may do as well. If they don't, then in my view, this is my legal background coming in my view, this is potentially foul of the Equality Act 2010, and it's one of my pet projects. So please do just drop me a line and I will happily, and we've done this many times, fight the fight for you with your HR, because that's something that is just not acceptable. And with your pension, you can be fairly aggressive with it because you have many years, many decades to be able to get that money back. So you can afford to take a bit of risk. Okay, so you get married. At this point, an Islamic will could be potentially a great option. So Islamic wills are, and I think this is probably the only time I'll talk about it, so I'll probably talk about it in a little bit of detail. If you are a Muslim in the UK, then you need an Islamic will. Because if you don't have an Islamic will, your money, your inheritance, your estate will be divided up according to UK law, which is not what Islamic law says. So the majority of your money will go to your wife, which under Islamic law is not what happens. Your wife will get a very set percentage. It will be either 1/8 or 1/4 if you don't have any children. And then other people will get their set allocation as well. So in other words, you need to get an Islamic will. There's roughly, I'd say, 3 options. The first is get yourself a free Islamic will. So if you have a really simple estate, if you have assets that are, not very much, you might be a student, you might not be married, it's very simple, then a free Islamic will works perfectly fine. And my first Islamic will was a free one. Then you have people who have assets over 2 million, and you need to have a will that is really bespoke and well crafted from a tax efficiency perspective that is really bespoke. Then you should go to an Islamic wills solicitor, and there are a whole range of solicitors out there, like JMW are based in Manchester, they're good. iWills is another one in Birmingham, and then Farani Taylors, and there's many of them. You can just Google them. And then we offer wills as well. Islamic Finance Guru offer online wills. So we have two kinds of wills basically, where for most people their affairs are very simple and they don't need necessarily a all singing, all dancing will. So we offer a simple will for them. And then you have people who will need a bit of tax planning, and to make sure that they avoid that, we have a trust-based will. But the key thing that without boring you about wills, the key thing to take away here is that you definitely should get one. And if you have assets over 325,000 and you've got a house that's going to be worth a significant amount of money, then you definitely should be looking at getting a will, because you want to make sure that you're not going to be handing over tens of thousands, if not hundreds of thousands, in tax to the tax man, because inheritance tax these days is 40%. So that could be very, very significant. And the reason why we do Islamic wills is because, as I said, we want to make Muslims richer. And one of the key ways that we can do that is by making sure that 40% of someone's entire wealth is not, paid in tax. And I think that this is, inshallah, something we can look at. You should, I'll skip over the marriage allowance and the tax-free gifts. Basically, if you make a gift in your lifetime, that is tax-free as long as you live for 7 years after that. So that's a great way of tax planning. Okay, cool. So we won't talk about your first house, because that's basically all about Islamic mortgages. And then after that, when you have your spare cash, as I said, you should start diversifying and getting into lots of different investment classes. So let's dive in then and start talking about the various different kinds of investments that we should have. But before we do, let's have a run through of the three absolute essentials to investing. And what I mean, and this is more of a kind of a philosophy of investing, or a kind of three principles of investing type section. So the first thing is, how do you become like Warren Buffett, the famous billionaire? You need to do two things, which is, it might seem quite obvious, the first one, which is actually invest. But sadly, we are often quite lazy about these sort of things, because no one's going to chase us about this stuff. And I think that leads to people often leaving their money in their savings accounts for many decades. And that is honestly such a big mistake, because every single year you're losing 2%. Every single year you are getting your money eroded away by inflation, and that's just not something you should tolerate. The second thing you should do is invest like the 1%, and we'll talk a little bit about how the 1% invest very shortly. So the three essentials to investing: the first is be consistent, be regular in your investment, and this is honestly the single biggest determining factor of whether or not you're going to have a great retirement pot or not. Just be consistent, be regular. Don't try and pick an entry into the market and try and pick a winner. If you are a doctor or a lawyer, or you are an engineer, a shopkeeper, or whatever you are, that's great, right? But you're not a stock trader, and you shouldn't try and do that. I don't try and do that, even though I love this sort of thing. I don't try and do that, and neither does people like Warren Buffett and other investors, because it takes a different kind of skill. And what you have, to your advantage, is that you can hold for long periods of time without any problems. So you should use that to your advantage. You are not someone who has access to, the quickest data stream that is giving you all the latest share prices as the big brokerage houses across the world are getting them so that you can get in quick and make and buy and sell those trades. You don't have a quantitative investment strategy that is run entirely by robots, run from a massive supercomputer. This is actually stuff that happens. You don't have that. So play to your advantage, which is invest consistently and regularly in just great companies. And if you don't know great companies, invest in funds or tracker funds. That's a great way of investing. Secondly, diversify. Don't put all your eggs in one basket. That's an obvious one. And then the third one is have a long-term time horizon, because there's nothing that really heals an investment pot than long-term time horizons. Because over the short term, you might lose some money. That's fine, because if you have a 30-40 year time horizon, then that is overall going to work out. And this is these are kind of examples of each of those points being borne out. So consistent and regular. This is the net worth of Warren Buffett. Now, as you can see, our man was not very rich at the start, but he built up his wealth over many, many years. And it wasn't really until he got to 58, 59 that he actually really started accelerating his wealth. So if he had kind of given up at the age of 39, then you can imagine he would have not had the benefit of like 60 billion or so that came afterwards. So consistent and regular is really, really important. The other thing is diversifying. This is what I meant by how the 1% do it. We typically will invest in stocks, cash, and bonds. And this is all live data, by the way, from various different surveys that have been done. Whereas the 1% will invest in real estate, private equity, stocks, cash, bonds, hedge funds, and other things. And we can talk about at least some of those asset classes, inshallah, later on. And then finally, the reason why long-term time horizons are good is because overall, the stock markets go on an upward trend. And we won't go into the economic and philosophical and whatever reasons for why this happens, but that's basically what happens. And so it would make sense for you to put your money into stocks and shares and just generally investments, rather than let them just dwindle away due to inflation. Cool. So let's dive into the 5 main investment categories that we have. The first one is stocks and shares. So how do you invest in stocks and shares? I mean, what are stocks and shares? Any ideas, Talha? It's not a trick question.
Stocks and shares, when you have a share of a company. Large company, 100,000 different shares, and then you can own a certain amount of it. And as the value of the company increases, your share will increase, and sometimes profits are paid out in what they call dividends. So a certain percentage of the profit will be paid out, and you'll get some of that because you are technically owning a part of the company.
Brilliant. Exactly. That is. I mean, Talha, why am I giving this presentation to you? Mashallah, you've nailed it. That's exactly right. So stocks and shares are shares in public companies as opposed to private companies, and you can really think of investing in the stock market as a proxy to getting exposure to the wider economy, because that's what's happening. Where's the returns coming from for that company? It's coming from its activities. So if you have a whole bunch of investments across a whole range of industries in that stock market, basically what it means is if the economy is generally doing well, you'll generally do well as well, and vice versa. So how do you invest in options, in stocks? So you have 4 main options. And by the way, actually, before we go into that, the reason why stocks and shares should form one of the key bits of everyone's portfolio is because it's got all sorts of different flavors to it, because it's the whole of the market, right? It's literally everything in the economy will have a company associated with it, which you can invest in. And also it's very liquid, so you can get your money in and out relatively easily. And finally, it's so vast that you can easily put in a sizable chunk of your investment, of your pot, into stocks and shares without it being problematic. Like, you wouldn't want to do that in something that is illiquid or there's not very much of it, etc., etc. So there's 4 key ways that you can invest in stocks and shares. All of you, let's start with option 4 actually. All of you will probably have a little bit of exposure to it already via your pension. Then coming back to the first option, you can go to a financial advisor. Typically, if you have assets over 100,000 in particular, you should, you wouldn't do wrong by going to a financial advisor and just having a chat with them. I mean, you don't necessarily have to, but it can be quite useful if you like to have that conversation with people. The second option you can use is a robo-advisor. And a robo-advisor basically invests your money for you automatically on an ongoing basis. And what you do, and there's people like Wahid Invest is one of the common ones, or Sarwa is another one in the UAE, or you've got Coco Invest, and you've got a whole range of other ones as well that are in the mainstream, and they're not obviously Sharia compliant, but they are robo-advisors as well. And what you do is you just go online and say, I want a aggressive portfolio, and they've got a preset cookie cutter portfolio that they will just deploy your money into, and that's it. And you just give your money to them, and that's what will happen. Your money will be invested into that portfolio. And that obviously is very low touch. And then the third option is doing it DIY. So even within the third option, there's actually probably 2 routes that you can take. One is you can just DIY by setting up an account with a stockbroker. So stockbrokers are companies that have that relationship with the stock exchange, so they can take your orders that I want 10 shares of Shell, and they will take it to the stock market, all obviously digitally, and look for people who are going to be buying 10 shares of Shell. And then they execute that trade for you, and then your money hits your account on the stockbroker's website. And so this is the kind of DIY route. And we like stockbrokers like AJ Bell and Hargreaves Lansdown because they've got great coverage of Sharia compliant funds on there, which is, I think, quite useful. So on the DIY side, there's actually 2 flavors to it. So one approach you can take is say, actually, look, I'm happy to go the DIY route, but I don't really want to invest in individual stocks, because really to get a properly diversified portfolio, I'll need to research like 15 stocks or something. And I just don't have that time to do that. But at the same time, I don't want to pay the fees of a financial advisor. I don't want to pay the fees of a robo-advisor. I just want to do it myself. So what I can do is I can buy funds, Islamic funds, and we've got an Islamic investment comparison engine where you can go online, and all of the different Islamic funds that are available that right now are listed on there, so you can compare between them, the various different returns, etc. And then you can find them on somewhere like AJ Bell or Hargreaves Lansdown and invest in them. And there you have, suddenly when you buy into a fund, you have access or exposure to not just one company, but you have exposure to hundreds potentially of underlying companies that these funds have invested in. So that's a great way of just cutting down your your hard work that you have to do to invest. Then the second way is the fun way, which is where you do actually want to learn a bit more about the economy and research a bit more about companies and that sort of thing. And that's where you can actually research individual stocks and buy and sell those. And by the way, all of this, I mean, this whistle stop tour is really, it's a summary of a course that we do, Halal Investing for Busy Professionals, which you can check out on the website, which goes into all this stuff in a lot more detail, i.e. like what kind of strategies can you use to actually buy stocks, that sort of thing. Okay, so we have option 2. So we have the second kind of asset class, Sukuk. Talha, this is a probably slightly harder question, but I'm going to ask you anyway. What do you think?
Are they listed like Islamic bonds? I don't even know how they work, but that's what I've heard them referred to as anyway.
Yeah, exactly. That's pretty much it. I mean, it's, you can get a lot more complicated about it, but in a nutshell, they give you a fixed return, so like a regular return, unlike stocks and shares, which can sometimes give you a great return, sometimes not give you a return. Sukuk, if you put in £100, you're going to get back let's say £5 from it every single year. That's what a sukuk does, like a bond. And there are various different routes you can go. If you're a high net worth investor, you can get access to interesting, larger sukuk, but you kind of need to invest 100,000 or 200,000 into them to get exposure to that, which sadly is beyond the reach of many of us. It would make sense to go to a financial advisor again, particularly if you're a high net worth. The other route is robo-advisors. So my first time I actually set up an account with Wahid was because I wanted access to Sukuk, which they were offering, and I couldn't really get access to anywhere else, even on places like AJ Bell and others. So that's another great way that you can do that. And they're very conservative. The Wahid very conservative portfolio is basically just Sukuk, which is great. Then the third way that you can do it is DIY. So you can go online these days on places like AJ Bell, etc., and buy Sukuk funds. Then finally, there are now options to buy, private company Sukuk that are offered via the Angel Syndicate. And these are, this requires a minimum investment size of £5,000, and you're essentially investing into in this particular case, into a company called Godwin, which is a commercial development company, and it uses that money to make various different properties and then leases them out to people like McDonald's and Starbucks and Asda and that sort of thing. And it makes a fixed return from that, and then it passes a portion of that back to the investors. So that's another route, and we'll talk a little bit more about the Angel Syndicate later on. Then you've got property, and this is the one that every single Muslim and every single Desi knows about intimately, because this is the asset class of choice, for decades and decades. For my entire lifetime, I know this is the asset that people really love investing in when they're Muslim, and also gold for some reason. So those are the two. But property is a great investment. It isn't something that should constitute your entire portfolio, because property has a ceiling to it in terms of how quickly it can grow. And also it isn't diversifying your portfolio, is it? So you need to have a little bit of property, but not fully property. And there's various different ways that you can diversify within this as well. So the first thing that should be said is, and this is starting at the bottom of the page, Islamic mortgage of your own property is exposure to a property. So that's good, right? That's a big chunky bit of your portfolio that is already in property. So don't forget about that. The second thing, let's go to the top, which is that you can, even if you only have £100, you can get exposure to property, which is not something that was possible, let's say, a decade ago. But due to property crowdfunding websites like Yielders and others, that is now possible, and that's great, because you can actually get exposure to a property, an asset class that has grown significantly in value over the last decade or so, particularly in London. And then you can get exposure to more aggressive kind of returns. So with rental returns, you're probably looking at somewhere between 5 and 8% rental returns per year. But with crowdfunding on the development side, so what this means is, when I say property crowdfunding, what do I mean? What I mean is, there's a company like Yielders which says, look, guys, we're gonna buy this £200,000 property. In Yielders' case, they actually buy it using assets that they already have, and then they sell it down to various people, whoever wants to buy it, until it's got, let's say, 200 different investors who have each invested £1,000 each. And then those investors are the ones who own that property. So that's how property crowdfunding works. And with a development, it's the same thing. They say, look, guys, we need 200,000 to build this project, and it's going to make lots of returns afterwards. And so the same process is followed, and it gives you a better return. And it's a different kind of asset class. It's a bit more of a riskier asset class, because obviously you're building something, it may not sell, that sort of thing. And with the Yielders, they say that you need to invest at least 50,000 to get access to these higher return deals, which can be up to 15 to 20% sometimes as well. And then there is Ethis Crowd, which is based in Indonesia, and they offer really good returns as well, 10 to 15% on various different developments out in Indonesia. And they, we've worked with them for a while now, and we really like what they're doing. And that's something to look into as well. And by the way, all of the stuff that I'm saying is on the investment comparison engine, so you can easily go back to that and compare it and read our reviews, our detailed reviews on each of these sections, so you can really understand what you're getting yourself into. Then you've got land crowdfunding. So this is taking it a step earlier when you've got a greenfield site, no planning permission on it. People think, actually, this has got real potential to get planning on it, and that will alone raise its value a lot, and then we can sell it on to a builder. That is offered through a company called IntroCrowd, which again we've worked with for at least a year now, and we've had really good experiences with them. And they're also some Sharia compliant as well. All of these guys, by the way, are Sharia compliant, certified by a Sharia scholar, and FCA authorized as well. Then you've got REITs, so that's real estate investment trusts. And these are funds essentially that you can buy on places like Hargreaves Lansdown, AJ Bell, etc. And make sure that you are buying a REIT that doesn't have any debt in it. So you need to do a few screens for that. But once you have that, that is a great investment to get yourself into, because that's just a nice passive exposure to property. Then you could DIY it. So you could literally say, all right, 50,000, I'm going to put down a deposit, I'm going to get myself a house, or maybe I might buy it on auction, I'm going to do it up, and then I'm going to sell it on. So that's another approach that you can take as well. Great. Savings accounts. These are probably the asset class I can get least excited about, but they are ultimately quite useful because they can keep your money safe from inflation. So for example, you are going to need a deposit to be put down for your property in December, and it's January right now, or it's March right now. You don't really want to put your money anywhere that is going to be very illiquid, because you need to be able to get that money quickly. You don't really want to be putting your money into anything that's going to lose that money, because if you do that, then you might not make your deposit. So you want to put it somewhere which is, it's going to protect it from inflation, but it isn't going to lose the money. And the safest place to do that is a savings account. So that's the kind of place where this is quite useful. And if you have large amounts of cash and not really sure what to do with it, the first thing that you can do is put it into a savings account and then decide what you're going to do with it, because at least then it's inflation proof. And savings accounts are on the investment comparison as well. There's a whole range of them. Al-Rayyan, Gatehouse, BLME, UBL, various others as well. So check those out. They're all Sharia compliant. And then finally, I believe we have private companies. So all of the stuff that I've talked about pretty much is on the investment comparison is stuff that we've collated it together. We've got various different partners that work with us on that, but we're not ourselves running anything when it comes to those investments. We just compare, analyze, and contrast. On the private company side, we have the startup syndicate, the startup angel syndicate, called ifg.vc, which invests in early stage startups. And this is an asset class that I'm very excited by, and it makes a lot of sense for people who have perhaps a little bit more liquid investments, liquid cash ready to invest. And the reason why I say that is because this is a kind of asset class unlike the others, in that you're going into it knowing that the majority of your investments are probably going to flop. But the idea is that the minority that don't flop to such a level that they just go through the ceiling and they cover absolutely everything else. And you can make phenomenal returns from angel investing. And to give you an example, when Peter Thiel invested in Facebook, I can't remember the exact numbers now, but he invested 500,000 into Facebook when it was worth I think 3 to 6 million. So very, very early stage. He got a big chunk of that money, of that investment. And Facebook, obviously these days, is worth literally hundreds and billions of dollars. So Peter Thiel with that £500,000 investment, obviously, he was rich himself because he was the founder of PayPal, so he wasn't doing badly. But he put that money in, and I believe he walked away with a 2000x return. So he became a billionaire many times over because of Facebook. And because of a relatively small investment, and friends of mine actually run a startup called Onfido. So if you guys have used Revolut or Starling or Monzo, you do those ID checks at the start, and you take a selfie, and at the bottom you'll see the logo of Onfido, and they're a company that do those checks. And alhamdulillah, those guys, all Muslims, have done fantastically well. And they recently raised another 100 million on top of the 100 million they've already raised. But the point I'm making in terms of the returns is that if you had invested in that company when it was worth 2 million and now it's worth $1 billion, that is life-changing money. So having said all of that, it doesn't make sense for everyone to invest in startups. And the reason why I say that is because typically to invest in a startup through the angel syndicate, you need about £2,500 minimum per deal. And because it's a kind of portfolio-based investment where you're going to lose a lot of money as well, you want to make sure that you're going to be investing in at least 10 to 20 startups. And then you don't want to allocate really more than 10 to 20% max of your overall portfolio to startups. So that means basically you need a fair bit of money, or you need to know that you will have a fair bit of money over the next 5 years that you will be committing to this kind of investment strategy. And you can do that through a variety of means. If you don't necessarily have that much cash, you can still invest in startups using companies like Seedrs or Crowdcube. These are crowdfunding websites. You do need to check, though, that the companies listed are halal, because they're not always halal. And then you've got our angel syndicate. We invest in, obviously what we think are great startups, but more importantly, we invest a lot in Muslim startups. So I think 80% of our portfolio is Muslim startups, and I think that's for us that's a really important way of meeting our second limb, which was supporting entrepreneurs to become the next big thing in terms of our mission. And then finally, you can do it yourself, right? You can, if you've got a presence on LinkedIn and that sort of thing, and you're involved in the tech community, like Bristol has a thriving, I believe, tech community, then if you hear of interesting deals, then let them know that you're happy to put in a cheeky 5K, cheeky 2.5K here or there, and get yourself started, because that's another way of just getting yourself in there. Then on the other hand, you've got SME financing. So this is sharia-compliant financing for small businesses. Oh, by the way, before I continue, on the startup side of things, you get massive tax breaks as well. So for pretty much every investment in the UK scene and the startup world, you've got something called SEIS or EIS, which means that if you invest £10,000 into a startup, you will get back as a tax break in year one £5,000. So 50 to 30% of your money you will get back in a tax break in year one, which is great. And if the startup collapses within 3 years, then the HMRC will actually pay you back an extra £2,500. So your at-risk capital is actually only about £2,500, which is great. So that's something to bear in mind, and that's actually the reason why a lot of people invest in startups these days in the UK. So on the SME financing side of things, this is investing in sharia-compliant small businesses, and you can do this in the mainstream using all sorts of platforms. But in the Muslim world, there hasn't been that many so far, and actually nothing is currently live right now. But in the next, I believe, 3 months or so, in the next few months, a company called Qardus will be live, which does sharia-compliant lending, sharia-compliant SME financing, which is great. It gives you a return of approximately, I would say, annualized about, 10%, 10 to 12%, which is a solid return, and it churns it over within a month or two. So it means that it's quite a good way of making short-term returns. And I'm really looking forward to them launching, inshallah. And then you've got a whole bunch of other companies as well that are in the pipeline. They've not launched yet, but inshallah they will do at some point. And I'm hopeful that they do, because this is something that is very, very much needed. So I believe, I've been talking for a long time, and I can see Talha getting restless, so I don't want to go on too long. But to reiterate my point, the reason why we do what we do, and the reason why we believe that you should, inshallah, spend some time sorting out your personal finances, is because there is a real, Islamic imperative here. And that is, we as an ummah need to work together to make sure that we look after the ummah as a whole. Prophet ﷺ, he says that إن المسلمين كجسد واحد إذا اشتكى منه عضو تداعى له سائر الجسد بالسهر والهمة. That the Muslimun, they are one body, and if one portion of it aches with fever or hurt, then the entire body will have that suffering. And so we in the finance arena, we need to have that mentality as well. It might not seem like it's a very impactful or directly relevant field to how the Muslim community as a whole fares, but it really is, right? And I just want to reiterate that final point about how Muslims are, out of the top 100 companies, when we should have 25 companies in there, we have one. And Muslims in the UK in particular, 44% of Muslims live in the 10% poorest constituencies. So that has serious impacts on our position in society and how we can practice our religion, etc. So this is a real needle mover if we all, inshallah, try and really focus on our finances and get those sorted. And we're obviously we've got a whole ton of content, free content on Islamic Finance Guru, and you guys should. By the way, I appreciate that. There's been a lot of stuff thrown out here today, and you might be thinking, I just need time to just work out what is going on. And an easy way of doing that is if you go on the website and you subscribe, the first thing we'll do is just send you a free course, a free email course going through some really, essential basic stuff when it comes to halal investing. So that should, inshallah, hopefully consolidate, a lot of the stuff that we've talked about today. But that's it from my side. Happy to talk about, get any questions and get stuck into them, inshallah.
Okay. Well, thank you. It's amazing to see how investment opportunities have increased. Maybe 30 years ago, when our parents were, just thinking about property. We've got so many options now, so it's nice to see. We'll get the questions together now. So and then otherwise, I'll get my own back on you and then give you some difficult questions.
Brilliant.
During the presentation.
Yeah, here we are.
Okay. Okay, so one of the questions were, what sort of returns do you get on REITs?
I think it's actually relatively stable, low. Like your average return from a rental property across the UK on average is about 5%. A REIT, you're probably, because they've got some fees and that sort of thing, you're looking at somewhere between, I would say, 2.5% to maybe 6% for maybe like commercial REITs and that sort of thing. So that's the kind of range. But honestly, I just check. But that's my sense of it.
Okay. And so the next question is, do Sukuks provide 5%? I guess maybe they're probably asking, is that generally how much they tend to provide? 5%? Is that a ballpark, or is there kind of a range?
It's a range. Sukuk they can range a lot. So it depends on the quality of the Sukuk, who it's issued by, and that sort of thing. But I suppose the question is a bit academic because we're restricted at the moment by what Sukuk we can get. And the Sukuk that we can get are basically via either private Sukuk like Godwin, which offers something like 8% or 11% per annum, or we can get something via Wahid Invest, and their portfolio, I think their conservative portfolio off the top of my head is somewhere like 5% annualized. But if you just go on the investment comparison engine, you'll see that. And that, the Wahid Invest ultra conservative portfolio is basically Sukuk. So that's a good way of seeing, and you can screen for the Sukuk options in the comparison and just see what the returns are there as well.
Okay, and the difference between a Sukuk and investment is the Sukuk, the actual money you put in doesn't grow. You just get a fixed percent. You get a percentage out of it, whereas with the investment, it would grow as well as the. Okay. So this is a tricky, good question. Have you had any success at your angel syndicate? I can put you on the spot here now.
No, it's a great question. So we have only been running for about, I'd say, 9 months, really. And in that time, obviously, it's hard to have a massive $1 billion company exit. Although I wish that would have happened. But the kind of things that we can point to are two things, I suppose. The first is the quality of the startups that we're investing in and who we are investing alongside. And then the second thing is that we have had two, if not three startups that we've invested in previously. So I invested in startups about a year and a half ago, and they are now, alhamdulillah, raising again successfully at a multiple valuation and doing well. So the first time they raised was 250,000. Now they're closing out an investment of 750,000 to $1 million. And another startup we invested in their first round, which is 800,000. Now they're closing out within 6 months later another 1 million round at a much higher valuation. So that indicates that we are hopefully doing a good job picking decent startups that are growing. In terms of the people that we invest with, so the kind of because alhamdulillah, I worked in the city and I worked in venture capital and private equity. You pick up some networks, and really this industry is all about networks ultimately, because you as an average kind of investor who is not in that community, you probably won't hear about a deal, and it just happens and it's done and you just are none the wiser. I mean, did you know when Facebook was raising for the first time? I know I certainly didn't, because we just weren't in that community, right? So it's about that aspect, and the kind of people that we invest with are tier one funds that are managing hundreds of millions of pounds. People like Jeff Bezos, the founder of Amazon, has invested in companies that we've invested in. The Bill and Melinda Gates Foundation have invested. Serena Williams, the founder of Red Bull, the co-founder of Twitter, has invested in a couple of companies alongside us, and various other ones as well. But in a nutshell, I think if we're wrong, they're also wrong, and I'm hoping then all of them are wrong. Otherwise, we're really screwed.
Yeah. Yeah, and I guess 9 months is quite a short time frame, isn't it, to assess any investment, isn't it? So it's yeah.
And one thing to say about startups is, it's a very illiquid investment. You're holding for at least 5 years, maybe even 10 years.
Okay.
So it's very, very long term.
Just got to sit tight and
hope for the best.
So another question we have is, do you have a portfolio that we can follow?
So I used to do lots of stock investment, and then I bought a house. And I bought a house in London, so that was basically the end of it. But I inshallah do plan to start stock investing again in the very, very near future. And alhamdulillah, we made decent returns. It was double-digit returns fairly consistently. But it wasn't. We weren't doing anything amazing. I'm happy to share with you what we were doing, which was just investing in solid companies. Probably we typically invest in small cap. Think companies between 10 and 50, 100 million in terms of market cap, year-on-year growth of revenue, solid growth, story about how they're going to actually become a bigger company, and you're looking for companies that are profit making. And we go into all of these kind of strategies. If this is of interest, then we go into all these kind of strategies and a bit more as well in the various courses that we do.
Okay. So another question, Jazakallah khair for the presentation, very informative. How does fund performance generally compare between Sharia compliant and mainstream tracker funds?
The Sharia compliant funds typically do better in times of prosperity, because the Sharia compliant funds are overexposed to tech, because tech doesn't have very much debt in it and it's typically halal. And tech has done very well whenever things are going well. So Sharia compliant funds have done historically quite well. During COVID and times of recession, I believe they do a little bit worse, but that's kind of to be expected. And we can't, as Muslims, this is part of the reason why I also want to create lots of large Muslim companies, because those are public companies that we're all invested in. And if you don't have non-tech Muslim companies that can be invested in, then there's very few options for Sharia fund managers where to actually put that money. So they put it all in tech.
Yeah. Okay. Thank you. What is the name of the SME financing that is starting?
It's a company called Qardus. So they're on our website as well.
Okay. Is that QARDUS?
Yeah.
Okay. I think that's the ones we've sent in. I think something I guess I'm wondering as well, maybe other people are. Does the COVID situation, would that change how you would invest, or the asset class you're thinking of, like property, or would you say just keep doing what you would be doing?
For things like pensions and like just steady investments, just keep on doing what you're doing. Like 20-30 year time horizon, COVID is just a blip, right? For a 20-30 year time horizon, it doesn't really make a difference. But if you want to be more canny investor and at least take advantage at least of some of the situation, then property might be a good shout. I would expect in the next 6 to 18 months to see a lot of cheap properties, forced sales and foreclosures by banks to come onto the market via auctions and even just estate agents. So if you have cash, then that could be a way to pick up some absolute bargains. And there is a bridge financing company called Offer, which you can access on our website as well on the Islamic Mortgage Comparison Engine. And Offer allows you to get bridge financing. What's special about that? Well, typically with an auction, you need to buy a property within 30 days, right? If you bid for it, you need to complete on it 30 days. And no Islamic bank will operate at that speed. No bank will. Whereas bridge financing providers do, and that's what they're designed for. So even if you don't necessarily have the full cash, but you want to buy this particular property, you now actually, for the first time, this Sharia compliant bridge financing provider has come along, and you can do that. And that's I think a game changer. And they've very recently launched, only a few months. So you may not have heard of them, but do check them out. Offer, OFFA, and you can just go on the website and look at them. I think we've got a review of them on our website as well. So check that out.
Okay.
Oh yeah, sorry, I didn't actually complete my point. So property is good. Your average investment's great. Invest in things that are kind of asynchronous. So like startups. And when we invest in startups, we are investing in startups that are deep, like research or deep tech. So by the time they're actually ready to launch, COVID will have kind of blown over quite significantly. So things like that, quite interesting. Or in a similar vein, land investment. Land is not going to be really affected, or planning permission processes are not really going to be that affected by the absence of builders, for example. So that's a kind of other way of thinking about investing because of coronavirus as well.
Okay. Well, Jazakallah khair for doing that for us today. I guess the take homes that we have really is like the consistency and starting early makes a significant difference. And as Muslims, to look at the kind of variety of options we have there. And if investing is done right, you benefit yourself by profiting, but also the ummah as a whole. and it's probably another kind of that's what we should be looking at, changing the way you view it. But Jazakallah for doing that for us today and taking time out, and inshallah I'm hoping people benefit from that.
Jazakallah khair, Talha. It's been a pleasure.
Assalamu alaikum. Is it?
You want to consider that? That's fine. Do you want
Is it?